Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Well, good morning. Thanks for tuning in to Financial Issues. Today is June the 14th of 2024. If you're watching along live with us at 8 a.m. Central, 9 a.m. Eastern Time, it is Rapid Fire Friday and our phone lines are open. You can get your call queued up at 610-363-1110 if you want to call in and ask questions. Well, questions about what, you might ask? Well, we're a ministry helping you to honor God in the way that you invest. So if you got questions about biblically responsible investing, give us a call. You can also learn more about our partnership where we help investors invest biblically responsibly, give them asset allocation models, a buy list, alert them of any sales for just $132 a year. So our main goals are to defund darkness through biblically responsible investing and to fund the light, to be a joyful and generous giver. Now, if you're listening at a time other than the time of the live show, you can go back and catch the full show by visiting our website, financialissues.org, or catch it wherever you like to listen to your podcast, Apple, Spotify, or the best place is our phone app, because then you can make sure that no matter which outlet you're seeing or listening to our show on, you'll always have us with you. Our stewardship verse today comes from Luke 14:28 through 31. For which of you, desiring to build a tower, does not first sit down and count the cost, whether he has enough to complete it? Otherwise, when he has laid a foundation and is not able to finish, all who see it begin to mock him, saying, this man began to build and was not able to finish. Or, what king, going out to encounter another king in war, will not sit down first and deliberate whether he is able with 10,000 to meet those who come against him with 20,000? Seth, what do you think?
It's a good one, Shana. Good verse, of course. I think when the scripture talks about counting the cost, I think that's shorthand for planning and executing the plan. You know, that's a good thing. Planning and following through on a plan, that's a good God-ordained thing. And honestly, Shana, it's God's idea. I mean, he has done this perfectly with the plan of salvation. You know, so we do this in a less perfect way, but in a true way nonetheless. And I think it's a necessary component for a God-honoring investor, especially. We trust in God, of course. We trust in his sovereign plan, and we hold everything with open hands. But it's good to use wisdom to make our day-to-day plans every day. And, you know, it reminds me of what Dan used to say often, that we live as if, we live as if Jesus is going to come back today, but we plan as if he's not going to come back for another 100 years or so.
Right. Yep. You know, God is a God of order, and he's a creator of everything. Yeah. He knows exactly how everything works, so he has all wisdom. He can be trusted to give good counsel. And just like everything else that was created, business was God's idea. Yeah. So, you know, the scripture really outlines some foundational concepts, pardon the pun there.
Nice, that's a good one.
Some foundational concepts for running a good business, and principles that we use here in the ministry as we're looking at businesses that might be good investments for our partners to consider owning or investing in. So when we evaluate businesses that we like to own, we want to know that the company has counted the cost that are associated with achieving successful outcomes, that they're, you know, willing and able to do the things that are going to make the business successful and generate return for the shareholders or the owners of the company. Just like in the Bible, you know, we're trusted with the parable of the talents and so many other examples in scripture. We're trusted to manage certain things, and then we're going to give an account to the true owner of those things at some point in time. So, you know, we see that happen in the corporate world. Publicly traded companies, they do their day-to-day operations, they strategize, they come up with estimates, they look at their business plan, they evaluate how it's working in relationship to what it should have done, and every single quarter those corporations, those publicly traded corporations, give an accounting or give a report of their stewardship of the company to their shareholders in the form of, we see that happen in earnings season. As earnings season gets kicked off and ramped up, every 3 months, we see those things reported. So, those are the things that, that's part of applying the wisdom of the scripture to something that seems pretty secular, like investing, but it's really not.
Absolutely, Shana. And, it brings to mind this concept that we've seen recently even. I know we've talked about Truth Social a lot, and we've seen other IPOs, different things like that. It actually reminds me of a question we got from one of our listeners. Okay. Carol Lee was saying that she just heard on Newsmax they're offering private shares to buy from them before they go public. I'm sure you've heard about this too. Just wondering, what do you think about this, Shana? What do you think about this idea of Newsmax possibly offering these shares before they go public?
Yeah. So it's a pretty common thing to see as companies start to try to raise capital to either grow their business or, really launch their business to a new level. And the short answer to Carol Lee's questions, or I guess the details about it, is that Newsmax has announced that they are planning an IPO for sometime in the second half of 2024 or maybe even 2025. They're saying there's information on their website right now that they have a private offering for accredited investors only, where they're offering 7% convertible preferred stock in increments of as little as $5,000.
And Shana, I think it's a good time as any to just ask a question for our new audience, having, the respect for them. They might not understand private shares, IPOs, these different phrases. What is a private share and what is an IPO?
Okay. So a lot of times, when companies get started, they have limited resources. They have private investors that invest. They have, a lot of companies invest, or founders of companies invest their own money, and then they sort of get to the end of that, and they really want to turn that over to the public or raise more money. So they'll look for ways to do that. An IPO is when the ownership opportunity of a company is extended to the public for the first time. So in an IPO, money goes directly to the company for deployment as they see fit. So they probably have some plans to make some acquisitions or to invest in new equipment or whatever it might take to get their business to the next level. And so buying shares on an exchange, whenever you buy shares on an exchange, typically you're not giving money to the company. You're just buying someone else's ownership in that company. So private offerings could be in the form of common stock or preferred stock, and those shares don't trade on an exchange. So the value for those kind of shares is a little bit harder to determine because you don't have an efficient market determining the price like you do in the secondary market. You have hundreds of thousands of investors that are bidding for and selling their shares, so you really get an efficient market. You don't have that kind of liquidity with private shares.
And Shana, for these IPOs, when I think about this, my guess would be that some of them possibly fail, right? They're trying to get startup and they just can't make it work. So how much emphasis should we put on when we see these and we think, that could be a potential good buy? How much emphasis should we put on waiting to see if the company has a trajectory of long-term health?
I think a lot.
Yeah.
So I am super leery of IPOs because there isn't a lot of history that we can look at to make a good assessment of the risk and potential returns. IPOs are very commonly very emotionally charged events that are driven by greed. So there's a lot of excitement, because you hear all these stories of how people made tons and tons and tons of money when they bought Microsoft when it was an IPO, or Apple, and how much those shares are worth now. But what you don't hear a lot is all of the IPOs that fail. So it's very, very common for a share price on an IPO to spike in the first day and then drop off dramatically. So, you really need to wait around and see how that company is going to perform and how they're going to deploy the capital that they raise initially. You hear the music. We got to take a break. Maybe we can finish our thoughts on this after we come back. We hope that you won't go anywhere and that you'll stay tuned for more financial issues.
Samaritan is direct sharing of medical needs. So every month, members are sending their checks or maybe electronic payment directly to another member that had a medical need. And so that helps it be much more affordable because it cuts out the middleman, and it also provides incredible flexibility for our members to make healthcare choices that they want to make, their healthcare dollars spent the way they want to spend it. So it's not their employer, it's not the government, it's them making the decision.
So I guess it is a little bit of a financial stewardship decision because, I personally have been using health sharing for a long time. And when I got off of the treadmill of traditional health insurance and switched to health sharing, my family saved a lot of money on our monthly premium costs just to stay protected.
Head over to financialissues.org/highlights to catch the complete interview and learn more about Samaritan Ministries.
What I love about being at Timothy Plan is the history that we have. We turned 30 this year, and it's just exciting to think that we have had 30 years now where we have impacted the culture for the better and helping people understand and knowing what they own. Timothy Plan has a team that is doing the research full-time, headed up by Doug Alley, who takes the lead on that department. And he is looking at these companies on a very regular basis. We listen to our shareholders. They call in with questions. We do a lot of research, and we try as best we can to handle this situation because we know that it affects not just our corporation, but our families and our children.
That was so helpful. At the end of the day, what biblically responsible investing really is just honoring God.
Watch the full interview on our website. Visit financialissues.org/highlights to learn more about Timothy.
Preborn banner.
Welcome back to Financial Issues, everybody. Good to be here with you today. We're going to continue that conversation that we were just having about IPOs later in the show. So if you only catch us on a half-hour version of the show, that's all the more reason to find the full show. You can get our podcast on any of the podcast platforms. The best place to get it is the FISM app, where you can get every full show for free. So, Shanna, why don't we pick up that conversation later on in the show here?
Yeah, because I think we need to get in the know.
Yeah, sounds good.
At Financial Issues, we help you to stay in the know about the financial issues of the day. We help keep you abreast of what is happening in the economies and the markets and help you understand how that impacts your own personal financial issues. So lots happened in the last week. I'm going to try to give you a recap with some of my own opinion kind of injected into this. So, the big news this week was the Fed's interest rate decision, which was unchanged. We'll get to that in a little bit. But, of course, the Fed, and as you might have seen earlier in the week, we talked about what their job is. And they have a dual mandate, that is price stability to keep inflation at their 2% target and to keep full employment. So to create conditions, financial conditions that are going to be good for business that keeps unemployment low. So low unemployment and low inflation means a good economy, and that's what the Fed is tasked with doing. So let's take a look at some of the information that came out, economic data that came out this week. And a little bit last week. The ADP numbers last week. So the first week of every month, we get the labor numbers that come out. We get several different reports. We get a report from ADP. ADP is a company that tracks and does payroll for more than 1 million companies. So they have their finger right on the pulse of the private markets. Then we get a government number or an establishment survey that is put out by the government, and they do surveys. They pick up the phone and they call people and they ask questions. And then they also have a non-elected panel that is appointed by the current administration that makes some adjustments to that model. So we've seen in the last year a pretty good deviation between the establishment reports and the ADP reports. The ADP numbers showed more evidence of a slowing pace of demand for workers last week. In 2023, now I'm going to give you some context to go by here. In 2023, average job growth reported by ADP was 209,000 jobs a month. Remember that number, 209,000. Now, if we look at the most recent 12-month average, not the whole full year 2023, but in the last month, the average has dropped to 194,000 a month. That's 15,000 lower on average than what we saw just 6 months ago. Now, the trend gets even worse if you look at the 6 months. So for the last 6 months, roughly 2024, the average is 166,000 versus that number I told you to remember, 209,000 in 2023. That's a pretty substantial drop. Now, the 3 month is only a little bit better than the 6 month. So the 3 month average is 184. That's 25,000 less than the average, that number I told you to remember, from 2023 of 209,000. So, it's not a bleak picture yet. Unemployment's not up over 5%, but it seems to be heading in that direction. So ADP sums things up by saying this: job gains and pay growth are slowing going into the second half of the year. The labor market is solid, but we're monitoring notable pockets of weakness tied to both producers and consumers. If we turn our attention to the establishment report, the government numbers, we see further evidence of a weakening labor market, even though the headlines seem really great. So there was a slowdown in the pace of hiring in April, in the April jobs opening data, where it totaled a little over 8 million versus the previous month, almost 8.5 million. So job openings in this report, job openings, job quits, and the hiring rate were all down and in a downward trend. All three of those numbers peaked in mid-2021 to early 2022. Now, the establishment report, the government jobs number, continued the smoke and mirrors games that leave the followers of Bidenomics either gleefully ignorant of what's really happening or deceptively manipulative. Not sure exactly which one it is. You can kind of come to your own conclusion on that, but they are claiming that Bidenomics is working, while we know we're paying at least 20% more, if we go with the government calculated number, for everything since Biden took office. You've heard me submit on more than one occasion that it really feels like that inflation number is much higher than 20%. The establishment report reported that payrolls grew by 272,000, almost 100,000 more than what was expected at 180,000. Revisions, remember that keyword revisions, to the two prior months were down a combined 15,000. Here's what's really happening. We are being misled by the initial numbers, establishment numbers, that are getting consistently revised down. So year to date, it says a little over 2 million jobs were initially reported to have been created, but so many of those jobs have been revised away. And there were 408,000 jobs that were lost and 250,000 people that have just dropped out of the labor force. The unemployment rate rose by 0.1 of a point to 4%, matching the highest rate since November of 2021. This is still historically very low, but it is on the rise. Again, I do not have a lot of confidence in the government numbers that are being reported. Government number reports total jobs, not total workers. This is a known fact. So jobs, I guess, technically are being created, even though many of them are being revised away, but not as many as the establishment initially tells us. So the household surveys, which counts number of people employed, has flatlined since late 2023. So More jobs, same number of workers. What does this mean? It means people are taking more jobs to make ends meet, not more people working. In the last year, our economy lost 1.2 million full-time jobs and gained 1.5 million part-time jobs. So this is intentional, I believe, to get more people dependent on the government, because what happens when you have a part-time job? You don't have company benefits. You end up in the marketplace on Obamacare because you don't have a company plan. And how much savings do you really think people who have 3 part-time jobs and barely make ends meet put back for their future? They don't have a 401k because they don't have a full-time job. And are they really putting money back on their own if they even can? What this means is that more people will become more dependent on government programs for their retirement, and that helps a party who wants more control, because a less confident American means someone who is more dependent on government, and that gives them the right to redistribute the wealth. So illegal immigrants are also getting most of the jobs, and somewhere around 40% of illegal immigrants are on government benefits that they've never paid for and probably never will. So what do you think is going to happen when these illegals get a path to citizenship and a ballot in their hand? What about the weekly job numbers? Let's get back to the economic data. Well, more support for a weakened job market. Initial jobless claims that came out yesterday popped to 242,000, which was much greater than the estimate of 225 and 229,000 more than last week. So inflation, well, this is the Fed's second mandate. May CPI, which is a measure of inflation, was flat headline and higher by 0.2% core, both 1/10 below expectations. This brings the year-over-year rate of inflation to 3.3 and 3.4% respectively. Wholesale prices, which is PPI, surprised to the downside with a 0.2% drop versus the estimate of up 0.1%. Core PPI saw no change month over month versus the prediction that it would be up 0.3%. So the BLS said that almost 60% of the headline drop was due to a 7.1% drop in gasoline prices, because we're jacking with the SPR again. We're taking oil out of reserve to get oil prices down. Well, gas prices ex food and energy rose 0.3% month over month. So all this to say, having a reportedly good jobs and inflation read, the Fed found it really hard to justify starting the 3 rate cuts that they were predicting that they will do this year. The Fed left the Fed funds rate unchanged and made modest changes to their statement and their summary of economic projections. They tweaked the inflation wording. On May 1st, they said that there has been a lack of further progress towards inflation. They took out lack and added modest. Now they're saying that there has been modest further progress. They kept the wording in about its lack of full confidence that inflation is showing great progress toward their 2% goal. And on their dot plot, their summary of economic projections, they kept 2024 GDP at 2.1%. They kept their unemployment prediction at 4%. Hey, we're there. In fact, they see higher unemployment in 2025 at 4.2%. They raised their headline and core PCE forecast to 2.6% and 2.8%. And 4 Fed members want no rate cut this year. 7 expect 1, and 8 forecast 2. Officially, the dot plot showed that policymakers see only 1 rate cut this year versus the 3 that they were expecting last year. Well, now that you're in the know about recent and upcoming financial issues, we hope you'll learn more about how we can help you integrate those issues into your own stewardship. Find out more about how we can help you defund darkness with our biblically responsible investment strategy. You have to leave us for today. We bid you a farewell and a good weekend and a very, very happy Father's Day. For the rest of you, we'll be back right after this short break.
Investing is about so much more than money. It's a way we can provide a better future for our loved ones and make a greater impact for the things that matter most to us. Good stewardship is investing in things that last for eternity and not things that go against biblical values. For over 25 years, Financial Issues has provided partners with the tools they need to build a portfolio that honors God and blesses others. Become a partner with Financial Issues today to see how you can steward your resources in a God-honoring way.
Through the ministry of Preborn, the Financial Issues family has saved tens of thousands of lives of babies. What an amazing job that God has done through you, the Financial Issues family. Would you join us in saving the lives of babies? What an amazing reunion we will have in glory, meeting all the people that we have saved. Please go to preborn.org, that is preborn.org, or financialissues.org, and click on the Preborn banner.
In the last 10 to 15 years being in ministry, being married, something that has been constant in our lives is Samaritan Ministries. As we've moved, we've had babies, we've had different things come up, we have just been able to rely on Samaritan in ways that we never really even thought about before becoming members.
Our heart's desire is to plant roots and be in a place for a really long time. It's how we were raised. We see the benefits of that, but we also see the open-handedness of being used by the Lord wherever He calls, because we just assumed when we started pursuing church planting, the quickest way to get from point A to point B is a straight line. And with the Lord, sometimes you find out it looks a lot more like this. And yet, Samaritan was with us through the entire thing.
We didn't have to look into, we have to change insurances now because we've moved states or whatever the case may be. And it's just been a real blessing to us in different phases of life.
I'm Kyle.
I'm Colleen.
We're the Gen X.
And we're Samaritan members.
So I was just getting on my feet and I met someone and I got pregnant and I wasn't ready. How am I going to raise a baby? And I barely can take care of my daughter and myself right now. I Googled abortions and I scheduled an appointment thinking it was an abortion clinic. When I was at the clinic, after they told me how far along I was and that the baby had a heartbeat, I cried. And it gave me a minute by myself in the room. I broke down and I prayed to God. I asked the Lord to, when I walk out of those doors, to just give me the strength to be able to go through the pregnancy. Made my decision at that time. I'm super grateful that I'm able to go down this journey with my daughter. And I'm just super glad that I didn't have an abortion. I've learned how to trust God. It feels amazing.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shana are hers alone and are for informational purposes only and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to your situation prior to personally implementing it and consult any financial professional you work with to make sure it's applicable to your financial plan.
Thanks for sticking with us at Financial Issues. We hope that if you listen to a short version of the show that you have found us. It's today's Rapid Fire Friday. We want to hear from you. 610-363-1110 is the phone number. You will be the first caller in the queue today. So surely after a week of excitement in the financial markets and the economic markets, surely you have some financial questions. Give us a call. 610-363-1110. Speaking of the markets have responded very positively over the last week to the economic news and the Fed's decision to hold rates steady, at least for the time being. For the week, the Dow so far is indicating, if it closes as it's been trending this week, down about a third of a point. The S&P, after seeing its fourth straight record close yesterday, is up almost 2% in the last week, and the NASDAQ is up 3.38%. The pre-markets were taking a bit of a breather this morning, indicating that it would open lower, and the market has opened lower. So the Dow is down almost half a point. The NASDAQ down about a quarter of a point. The S&P 500 down about a third of a point this morning. So taking a little bit of a breather is not the worst thing in the world, since valuations in the market are still pretty high from a historical perspective. We're sitting with a 21 times multiple on the S&P. That is a measure of valuation. It is historically higher than what it is, and typically when we see valuations get so much higher, something happens to correct those things. So,
yeah. Well, Shana, we had mentioned earlier in the show about getting back to this conversation about IPOs and different things like that. And one of the terms that we have been talking about is this idea of an accredited investor. Can you tell us what that is? What is an accredited investor?
Yeah, so for maybe those of you first tuning in, we had a question earlier in the show about Newsmax announcing that they are going to do an IPO. They're going to go public. They're going to start to allow public investors to buy their shares. But for right now, they are doing a private offering for accredited investors only. So quite simply, an accredited investor is a person or an entity that is allowed to invest in securities that are not registered with the SEC. So publicly traded companies are registered with the SEC. They have reporting requirements. They've got to report their results in a certain format every 3 months to the public, so the public can know, get a sense of transparency about the health of the company and whether they want to be an investor. So private companies do not have some of those same requirements. And so they are considered to have more risk, less transparency, so on and so forth. So you have to be a more sophisticated investor than just, the average mom and pop investor. So an accredited investor, to be considered accredited, you have to have a certain income and or net worth guidelines. So if you've earned $200,000 or more for the last 2 years, then you can be considered an accredited investor. If you're married, you have to have $300,000 or more. Or you can be an accredited investor if you have a net worth of at least $1 million, excluding, in most cases, the value of your primary residence. So there are situations where you can include it, like if you have negative equity in your mortgage, or you have a home equity line of credit. The SEC some years ago added another category for accredited investors, and that's individuals who have certain professional certifications, designations, or credentials. Like, let's say that you have a securities license, then you're considered to have a much better understanding than the average person for financial investments. Individuals who are knowledgeable employees of a private fund, and SEC and state registered investment advisors are also considered to be accredited investors. So just someone who has a little bit better understanding than just the average Joe about investments.
It's awesome, Shana. Hey, let's pause there for just a second. We're getting a call from Arnold in Texas. He is looking for some more information about the partnership, if that's all right, Shana. Arnold, good morning. You're live on Financial Issues.
Good morning.
Hi, Arnold.
Hello.
What's on your mind this morning, Arnold?
Well, I've been a partner for 3 or 4 months. We haven't actually made any moves. We're just looking at what you're doing. My concern is all your alerts here lately there's been tons of sales that for one reason or another you're alerting us to sell things, but there's hardly anything new on the buy list. I'm curious why there's not more things on the buy list to replace the things that you're telling us we need to sell.
Yep, that's a great question. So we do have some commentary there for partners on the partner side of the website too, and it's intentional. goes along with what I just said a while ago. The market is very overvalued in general. And, whether the market is at highs or lows, there's typically always going to be some pocket of opportunity that we can find for investors, and that's what's going to be represented on the buy list. And so, either when the market is doing really well and it's just hard to find good entry points, the buy list will be smaller than usual. On the flip side of that too, when conditions are more challenging, when the market's taking a dive, the buy list will probably be smaller at that time too, until we get to the point where we have a lot of confidence. Then you'll start to see it grow. So, just proceed with caution right now. Fill out what you can for your asset allocation models, because what's on the buy list is going to represent the very best opportunities for the environment that we see. I would fully expect that, and I don't know how quickly it will happen, but as conditions change, more things will come onto the buy list. So, we typically recommend that you build out, if you're starting from an all-cash position, or if you're generating a lot of cash from sales that are happening, that's okay. For most of us, our cash positions are paying 4.5% to over 5%. That's not a bad place to be waiting for things to come on the list.
Okay. One other question, if I could, please. Okay,
go ahead.
The market as a whole, the numbers they put out over the last 30 years averages about 10%, the S&P and stuff. So my question is, how, I know biblically responsible is the biggest part of what you're doing, but if the market as a whole is averaging 10% and on general, you guys are averaging 6 or 7%, being retired and requiring a lot of our income coming from our investment, how do you have any numbers of what average partner makes on average a year? Are y'all matching the market basically, or can you give me any numbers on that?
You know what, Arnold? We're going to have to hold you over until after the ag. We have the ag report coming up, and I don't have quite enough time to address that question. So if you'll hang with us, we'll come back to you after we get, because I do have a good answer for you. So that's a good thing. And I do just want to clear up for anyone that might not continue listening. I think Arnold just made a guess about what the 6 to 7%, that is not a posted return for our strategy. And I'll address that a little bit more as we come back. So we are going to hear from Craig Haugaard with the Ag Report. He's going to tell us what's happening in the agricultural and commodity markets. After that, we're going to take a short break, and then we're going to get right back to Arnold and his question, and maybe even finish up our conversation about IPOs. Here comes Craig.
This is Craig Haugaard with your Financial Issues Ag Update for June 14th. Corn rallied on the strength of good export sales numbers and hot and dry forecasts. The eastern U.S. Corn Belt is looking at high temperatures and below-average rain for the next couple of weeks. Now, it's worth noting that when the weekly drought monitor map was released yesterday, it showed only 2% of U.S. corn production in any form. 57% of the U.S. corn growing area was experiencing some form of drought. Yesterday's close had July corn 4.5 cents higher at $4.58.5. Soybeans reacted to hot and dry weather in the eastern U.S. and a string of flash sales of soybeans to China by moving higher. July beans were 12.25 cents higher for the day at $11.89.5. Argentina's Rosier Grain Exchange declared that nation's about to set a production record for wheat, while in Russia's Sovkhan says that Russia's June wheat exports are going to be a record, someplace in the 3.5 to 4 million metric tons area. Now, the 5-year average for the month of June for Russian exports is 1.6 million. Toss in U.S. harvest pressure. It was pretty tough for the bulls to gain any traction during yesterday's session. Minneapolis July wheat was $0.0125 lower at $6.67. Kansas City declined by 0.5 cent to close at $6.36 3/4, and went Chicago 3 cents higher at $6.20. Cotton futures spent the day in a very tight trading range. Now, at the close, the July futures were down 39 points as we ended the session at 71.35. Livestock futures were mixed. August live cattle were $1.17.5 higher, $179.50 per hundredweight. August feeder cattle were a dime lower as they settled at $257.47.5 per hundred. And we had August lean hog futures $1.35 lower at $88.60 per hundredweight. Class 3 milk futures had a huge day as they established a new life of contract high and then closed above the old high. At the closing bell, the July futures were up 49 points, settling at 21.09. Well, this has been Craig Haugaard with your Financial Issues Egg Update. We'll be right back with more financial issues after this.
In a world where financial decisions can feel overwhelming, it's easy to lose sight of what truly matters. But what if there is a way to align your financial goals with your deepest values? Financial Issues has helped us navigate the complex world of finance through a biblical lens. By prioritizing and investing in a way that honors God, Financial Issues has empowered us to focus on what truly matters: our family, our faith, and our future. With Financial Issues by our side, we can invest knowing that our financial decisions are in line with our values. Take the first step today and become a Financial Issues partner to access rich online resources, training tools, and guidance for biblically responsible investing. Head over to financialissues.org and learn how to invest your money in a way that honors God. That's financialissues.org.
Samuel Case, news anchor with FISM News, sits down to read real comments from real viewers.
All righty, another big man here. Let's see. Ooh, upside down. Jen Harris, 52. She says, "Whoa, this is how I remember the news being when I was younger." Well, Jen, are you actually 52 years old? That's not too old. You don't have to say when I was younger. You're young now. Anyway, she says, it was just information back then, read by a person who read well and said things in a way that was pleasant to the ear, but no bearing on the information. Well, Jen, I gotta say, that's awesome that you think I read well and that I'm pleasing to the ear. Actually, I gotta ask, is this a legit comment or you guys pulling one over? It's real? Okay, well, Jen, you have a good taste in news anchors here. And it's also awesome to hear that you don't think we're overbearing with our opinions and that we're just getting right at the point and that you're actually getting legit news from us here at FISM News. That's awesome.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back to Financial Issues. We're in the home stretch of Rapid Fire Friday. We've got a couple callers, so we're going to get right to that. We were talking to Arnold about the historical returns in the market versus what to expect in a strategy like Financial Issues. So, Arnold, I think a common miscalculation or mistake that a lot of people make is they'll look at the return of the market over history. It's true the S&P 500 has averaged 11 to 12% over the last 50 years, and investors typically want something to compare their own portfolio to. The something that I think that we hear the most about is the market, right? We're always hearing about the market doing this, the market doing that. The market's averaged, 10 to 12% over the last 50 years. And then people want to look at their portfolio performance and compare it to that. It's a terrible comparison because the market is 100% equity. The S&P 500 is made up of close to 500 equity investments. Now, someone who's in retirement would be making a big mistake if they were 100% in equities, because equities are, even though the S&P 500 has averaged 10 to 12%, you have very, very wide swings in there. Good years average somewhere in the neighborhood of a positive, like 15 to 20%, and negative years, although they happen less often than positive years, and that's why you get a positive return, but the volatility in the negative years can really hurt someone who's in retirement from two different standpoints. Number one, it creates fear and it can cause people to get out. So if they experience the kind of volatility that's in the market for their entire portfolio, they could abandon a really good strategy that would do well for them over time. Two, in retirement, most people are usually drawing down on their portfolios. And when you're taking money out of a portfolio, volatility is a very, very bad thing because you're having to sell things to get your income that will never have an opportunity to recover. So two things that I wanted to elaborate on in your question there. One was, and I think what you were getting at is being biblically responsible mean that we have to take a subpar return? I do not believe that that is the case. So only about 10% of publicly traded companies fail a screen for biblically responsible for consideration in a biblically responsible portfolio. That still means that 90% of publicly traded companies are okay. So, eliminating 10% of the option is going to, put a little bit more risk in, but in my opinion, it's worth it. There's been numerous studies done on comparable portfolios, biblically responsible versus non-screened, and there's very little to any difference in performance numbers. Now, does that mean that you can expect 10 to 12% in a biblically responsible portfolio? Well, maybe if you're willing to go 100% in equities, because that's what you're comparing to. So I think that when you're following our strategy, none of our strategies are 100% equities. So does that mean that historically, on average, you're probably going to see less of a return than an average of 10 to 12? If you're following our strategies, probably so. We believe that there's far more value in protecting on the downside against volatility than there is in catching every bit of upside potential, because volatility is a real killer. It's your friend when you're saving, when you're putting money in, because you're dollar cost averaging, you're getting lower share prices as you're putting money in regularly, but it's the exact opposite when you're taking money out. So, for any retiree, and I don't want to make blanket statements, because if you're a sophisticated investor, if you understand risk, if you've accumulated more assets than you ever need to spend, like let's say that you're only spending 1 to 2% of the entire value of your portfolio. If you're only taking 1 to 2% out every year, you can probably afford to be more aggressive. You can probably afford to be closer to 100% equity position. But for most people, that's not the case. So do you have to sacrifice return in order to have a diversified portfolio? Most of the time, yes. Because if you're looking at a traditional 60-40 portfolio where you have 60% invested in stocks and 40% invested in bonds, or let's just say you're doing 50-50 because it makes the numbers easy for me to do in my head. If stocks have averaged, 10%, let's just say, over the long term, and you've got 50% there, that gives you 5% towards your net return. If bonds, on the other hand, have averaged 5%, you're going to get a net 2.5% because 50% of your portfolio is there. So, you add those together and you're looking about a 7.5% rate of return for a 50-50 portfolio. So anytime you introduce lower risk, lower return assets into a portfolio for stability and protection on the downside, you're going to come up with a lower return.
That makes perfect sense. I appreciate all your information.
Great, Arnold. Well, we really appreciate your partnership, and we just encourage you to continue learning, about the strategy. And when your confidence level is up, go ahead and put that into practice and start building your own biblically responsible portfolio.
And, Arnold, I'll just say this also. Anytime you have a question, do what you did, man. Call in. This is the best way. Best way to get to Shannon and get your question answered right away.
It is, and you probably helped a lot of other people.
Yeah, for sure.
By asking that question.
Thank you very much.
All right.
Thanks,
great.
brother. God bless.
Let's get to Eddie. Eddie's calling us from Tennessee. Hi, Eddie.
That's good. Good morning, Eddie.
Well, good morning, guys.
Good morning.
Morning.
I don't know if this is a quick question, but it's just one question. I want to ask about FI-70. I noticed that it's on the sell list. I got into investing in FISM back about 3.5 years ago. And the first thing Dan told me to do was take a big chunk of my money, retirement money that I'd moved to Fidelity, and put it in FI 70. And it's been given some great returns up until last year or so. And what I was wanting to tell the last caller also, even with right now I'm down 25% in FI 70, and I have a large amount of that, but still my entire portfolio is sitting at 11%. So what I wanted to know is, can you lead me through the thought process to sell and reinvest the money that I have in FI 70?
Mm-hmm. Yeah, so I would encourage you to tune into the partner conference call. We're going to go a little bit more in depth, but I will give you just kind of a high-level overview. And kind of the reasoning for that, the reason that you're down in that is because it's a bond fund. And bond funds experience downside volatility in prices when interest rates go up. And that's what happened in 2022. We saw rates dramatically go up and the price go down. Right now, so, you know, it's counterproductive a lot of time to look at history and say just because you did something at one time and it was a good decision at the time to do it, it doesn't necessarily always mean that you stay there. So there's a better yield in the things that we're suggesting that you replace it with. So you're going to get better yield while you're waiting. And, you know, if you're overweighted in that particular sector, that means that you'll deploy money into other sectors, and there's probably better return, better recovery potential in other sectors. So if it's in a taxable account, the good news is you get to maybe offset some of the profit take or some of the rebalancing that you might have to do in other sectors.
Okay. That is a wonderful explanation. Thank you.
All right. And thanks for sharing, Eddie. I know that's so encouraging. It's always great when we hear people's experience. And, you know, I just want to quantify that by saying, you know, this is a do-it-yourself strategy. We give a lot of guidance. We give buys. We give sell recommendations. We give asset allocation models. But at the end of the day, you know, you get to really pick what goes into your own model. And, of course, people's returns are going to, you know, vary by the decisions that they make. But it sounds like you've been doing a great job, Eddie.
Well, thank you very much.
Thanks for calling.
Thank you, Eddie. Hey, Eddie, it's also great to hear your voice, brother. I see you in the chat almost every show, so great to put a voice to the name.
Yeah, thanks for calling too.
Yeah.
Oh yeah, this is I love to get in the chat, and I love to hear all of the good advice that you give.
Well, great.
Awesome.
Well, tune in next week for that partner conference call.
Yeah.
So, speaking of that, if you are a partner, you'll get an alert early next week giving you the phone number to call in. It's going to be at noon next Wednesday. The date, I
June
think
19th?
19th? June 19th.
I need to know that, Shanna, because that's 2 days after my anniversary. So all the dates around here, I have those known.
Yes.
That's right. That'll be fun.
Another important date, Seth. I wanted to wish you a happy Father's Day, along with my father and my husband. You know, folks, I really encourage you to honor your fathers. I'm not a father, so I don't know, but I can tell it's not easy being a father. You have a lot of responsibility before the Lord for your walk before the Lord, for your family, and so many of our partners and the staff and our founder, Dan Celia, are really great fathers. And so let's appreciate our fathers this weekend. Let's honor them as the Lord tells us to do. We hope that you have a wonderful day of worship on Sunday. We hope that if you're a man, we hope that you lead your family right to church.
Amen. Take them to church.
and celebrate Father's Day. Well, folks, we hope that you enjoyed the program today. We're going to be back next week, Lord willing, with more financial issues, reminding you time's getting short. The Master is coming back. There's going to be a test, and we want to help you be found good and faithful stewards of everything that the Lord has trusted you to manage. I'm your host, Shana Burt. We'll see you next week on Financial Issues.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.